Good afternoon, everyone, and welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is from our new tax controversy series. The environment for tax controversy in the Asia Pacific region has picked up and accelerated rapidly in the last 6 years since the OECD's G20 Finance Committee met in Brisbane, Australia. And whilst we've seen tax office activity abate during COVID and governments providing a lot of incentives to businesses, that focus has now shifted back to tax collection. And therefore, we believe that a series focusing on tax controversy is both timely and extremely relevant in Asia Pacific. Given this environment, we've prepared a special 3-part mini-series to introduce our controversy debriefs, the first of which was earlier this month and focused on general anti-avoidance. Our second session today will focus on transfer pricing, and our third session will go into the administration by tax authorities and controversy practices in the region. My name is Neil Pereira, and I'm a tax and legal partner based in Deloitte, Sydney, together with my colleague Annalie Mitchelson, who is a legal partner in Deloitte, Sydney. We have the pleasure of hosting today's webcast and the series. We have 3 special guest speakers with us today, all of whom are transfer pricing controversy experts in their region. Jacques Van Rie, who will cover Australia, Carlo Navarro, who will cover Southeast Asia, and Karishma Patapreka, who will cover India. You may access each of our bios on the left side of the screen. But before I go further into the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. Firstly, all users are on listen-only mode. If you have any content-related questions, you can submit them at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions either during or after the presentation. Secondly, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the polling question on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. And now on to our topic for today. Actionable moves have been made in the area of BEPS and the automatic exchange of information, with the majority of countries endorsing the OECD recommendations. Some jurisdictions have taken unilateral action, for example, in implementing a digital services tax, highlighting the difficulty in achieving consensus and potential distortion and mismatch between tax regimes. We've seen countries like the UK take the lead with various BEPS initiatives, and in our own Asia-Pacific region, many countries are close behind, adopting BEPS rules and especially new transfer pricing rules. In today's session, we wanted to explore how the transfer pricing rules operate in a selection of countries, and each of our speakers will take us through the key TP issues arising in their respective jurisdictions via recent cases and their own experiences with local transfer pricing laws. After that, we'll have our speakers in a panel session to provide their observations on key themes and issues we believe are most relevant to tax controversy in the region. And that brings us to the first polling question today. And our question is, what has been your recent experience with the tax office in relation to transfer pricing reviews or audits in Asia Pacific? Has it been cooperative and voluntary, formal and involving the use of statutory powers, adversarial and involving search and seizure powers, a combination of the above, or don't know, not applicable? And while we wait for those results to come in, I'd like to ask my colleague, Annalie, from your personal perspective, Annalie, what have we seen in Australia recently?
Thanks, Neil. I think it's fair to say that we've seen a range of actions from the ATO here, from very consultative reviews to highly contentious audits, where the ATO is regularly using its compulsory information gathering powers, including its powers to compel companies to produce documents held offshore. What's common across all reviews is that the process certainly moves more quickly and more smoothly if taxpayers can produce contemporaneous evidence and explain and prove that they had a reasonable and appropriate commercial basis for the structure or transaction under review.
Thanks, Annalie. And we can see that the results of our poll are in. What's probably pleasing to see is that not a lot of our guests today have faced an adversarial process. There's been a combination of cooperative, voluntary, and formal processes, as we can see from the results of our poll. That's great to see, and that sets the tone I think, for our speakers today as well. I'd like to now pass over to Jacques to talk about the Australian experience.
Thanks, Neil. So it's my pleasure today to talk about maybe the most anticipated case in the Australian transfer pricing landscape. And it's specifically important because of guidance issued by the Australian Tax Office when it comes to what they call marketing hubs or commodity transactions. So what we'll do today is, the case is a very complex case. I'll briefly touch on two key transfer pricing controversy points, and those will be around the methods and evidence. So on the screen, you'll see the group diagram for this transaction. This transaction dealt with an offtake agreement for the 100% sale of copper concentrate from an Australian mine, which was held by Cobalt Management, to Glencore International AG, the global trading company of the Glencore Group. So we could please move to the next slide. So what I'd like to do, just in the interest of time, I'll give you a quick summary of the case. As I said, I'm not going to go into every detail of this, but this case was heard in two parts. The first part was a court of first instance, which was heard or decided in September 2019 by Judge Davies and was found in favor of the taxpayer. The Commission then took the matter on appeal, and the appeal was heard or decided on the 6th of November 2020, again in favor of the taxpayer. I do note that the Commissioner has appealed to the High Court, and that will be hopefully heard later this year. It dealt with 3 years of income. What is really important to note, and specifically when I talk about the use of methodology and evidence, is that this case was heard under the old legislation, Division 13, together with Subdivision 815A, which brought treaties into the ambit of the transfer pricing legislation. Basically, the case dealt with an agreement for 100% offtake production of copper concentrate from the Australian mine to the marketing entity. As mentioned, the two entities were Cobalt Management and Glencore International. The pricing in the contract was an arrangement that followed industry standard terms using the London Metals Exchange, less a adjustment for quotational period, less a processing fee of 23%. And the report or the pricing mechanism was supported by industry reports and using the comparable uncontrolled price or CUP pricing. Basically, the first court of first instance was a single judge, which found in favor of the taxpayer, and then the full bench of the Federal Court of Appeal decided in favor of the taxpayer. The taxpayer largely won on all the grounds, but there was one matter that regarded the pricing of freight that was decided in favor of the Commissioner. What is important, and which we won't deal today with, is the concept of reconstruction, but more the reliance on CUPs. So if we move to the next slide, please. So in the full court, the Commissioner took issue with the following. Basically, the Commissioner argued that there was no range of possible outcomes for this particular mine, but just one outcome, namely the retention of the pre-existing contract. So there were two periods here at play, period prior to February 2007 and the period after. It was largely the period after 2007 that the Commissioner took issue with. But basically what the Commissioner argued, that there was no benefit to the Australian operation to enter into this arrangement. And it argued that the arrangement left the Australian operations commercially worse off, and that an independent entity operating at arm's length would not have agreed to such an arrangement. What is important, that the Commissioner did not attempt to reconstruct, but what the Commissioner did try and do was to reprice. So this wasn't dealing with reconstruction, and the decision was therefore around the ability to reprice the transaction or the contract. We move to the next slide, please. So if we look at the key focus of the case, the commissioner argued that third parties would not have entered into the amendment in February 2007. The judges, however, concluded that whether arm's length parties would have accepted the amendment was the wrong question. It did not focus on whether the amendment was in the taxpayer's interest. What the judges did say was that the right question was whether there was evidence of third parties behaving this way. And then the judges looked at whether the decision to enter in was their behavior post the decision in accordance with how arm's length parties would have behaved, and then the pricing, did the pricing align to that decision. So what is important is that the Glencore case turned on evidence on how the market dealt with and how third parties would transact with each other, and then the pricing was set with reference to that behavior. Next slide, please. So when we look at the decision of the court, it is important to note that in the court of first instance, the taxpayer led a lot of evidence around numerous contracts between unrelated parties. The taxpayer did not provide economic evidence, but was two forms of evidence. One was lay evidence by local management about the operational facts, and the second was expert evidence. In the court of first instance, Judge Davies did not make adjustments to these contracts. In the full court, or the full bench, the judges described the submissions of the parties on this issue as reflecting a degree of unnecessary energy about an issue which is perhaps not as nuanced or as sophisticated as the parties might have thought. So basically, the judges said that they went overboard in analyzing these contracts. What is important is that the court found that the contracts were valid reference points or acted as a sounding board for how independent third parties operate. And it acknowledged that the court should take into account the practical difficulties faced by both the taxpayer and the commissioner in finding evidence that grounds what is sufficiently reliable or which demonstrates that something is insufficiently reliable. The answer is therefore not to be found in the overly lengthy and complex expert reports. Common sense is required, and this is a welcome observation by the court. The outcome of this is that the role of CUPs as reference points remains the gold standard of admissible evidence in TP court cases. What is to be noted is that, if you read the judgment carefully, is that the strict requirements of CUPs was not followed by the court, but a broader interpretation saying these contracts were mere reference points and sounding boards. Next slide, please. We move on, thank you. So the second part is, the first part basically said CUPs are the gold standard and is the way to go. What was important also was providing evidence to support those CUPs. And as mentioned earlier, two forms of evidence were provided. There was lay evidence, providing documents and business records and witness statements around the decisions that were made. And then there was expert evidence around the industry and matters affecting how third parties would transact. What is important is the expert evidence should provide an opinion on the statutory question based on the facts and assumptions supported by lay evidence. So when taxpayers are looking at their transactions, it's really important that they structure their transactions in a manner that reflects industry standard and standard practice. Next slide, please. So in conclusion, when we looked at the expert evidence, the courts made a few comments around the experts. It said the expert reports provided opinions on matters outside of their specialist knowledge. And even without a foundation of the view expressed, it is not the role of these experts to be an advocate for the party, and experts should make it clear when a matter falls outside his or her expertise. So we need to be very cautious when using expert evidence. But if we look at this case, what is the message that comes out? Well, it's important that taxpayers place themselves in the best possible position to defend a transfer pricing position. Post the Glencore case, taxpayers need to be able to show that the terms of their transactions are no different to the terms that might reasonably be expected to be agreed between arm's length parties, even though this is now a point of appeal. And then once you've identified how the independent parties operate and you've structured your transaction, you support that and the use of cups through a combination of lay and expert evidence. It's a very important case in Australia. Thank you, Annalie.
Thanks, Jacques. It'll be interesting to see in the next month or so whether the High Court here in Australia chooses to hear the appeal, so things will be up in the air for a little bit longer here. We'll now hear from Carlo about Southeast Asia.
Thanks, Annalie. For Southeast Asia, we have chosen cases involving issues that are prevalent in jurisdictions of Southeast Asia, right? And you will note that not all, but only a majority of countries in Southeast Asia are actively conducting audits and disputing transfer pricing arrangements. For those of you who have operations in Southeast Asia, you are probably aware of the aggressiveness of the Malaysian and the Indonesian tax authorities, while Vietnam and the Philippines are just beginning to follow the footsteps of these two countries. So in today's webinar, we will look into two common structures in Southeast Asia and how these structures are currently or recently being challenged by the tax authorities. We will also be looking at the arguments presented in those cases to defend the structures. For our purposes this afternoon, I have simplified the matter presented in these cases, and you will note that the issues are by no means complicated, but it goes into the very essence or substance of the structure. Thus, I'll be discussing these two structures. The first one involves the financing structure, while the second one touches on the principal model that is prevalent in Southeast Asia. Let's look at the first slide for this afternoon. And in this slide, you will see a common financing structure that we are familiar with in Southeast Asia. This structure arose because of two things. You will note that most of the jurisdictions in Southeast Asia have their own limitations on interest deductibility. Some countries deny the tax deductibility of interest on shareholder loans, while in some cases, there are debt to equity, interest coverage, or earning stripping rules that limit the deductibility of this interest. We will note further that in financing via equity, there are restrictions imposed by these countries on the extraction or reduction of those capital. Because of these limitations or rules, multinational companies have used interest-free advances as a common financing model. And this financing model is usually preferred as this is more flexible in terms of repatriating the cash out of the countries, as they do not suffer from the same restrictions in extracting equity, right? We will therefore now look at how this structure is getting challenged by some tax authorities in Southeast Asia, right? The issue in this model arises when the tax authorities treat these advances as loans and deem an interest thereon. And this is prejudicial to the taxpayers because the deemed interests are not deductible for tax purposes. And therefore, it does not benefit them because of the limitations on interest deductibility imposed by these jurisdictions. On the other hand, rules of some of these countries impose withholding taxes on these deemed interests, despite the fact that the interest is not actually paid. Please do note that the issues that we will be discussing this afternoon arise only when a country has an interest deductibility limitation, has transfer pricing rules that allow the deeming of interest, and third, it imposes withholding taxes on that deemed interest, right? And now, let us talk about how we defended the structure. And I think it's obvious that the common defense against these challenges is to argue that these advances are not loans, but are equity. It sounds easy, but this defense actually goes into the very substance of the transaction, and thus we will need to prove the essence of the transaction. And how do we do that? The first step is to delineate the transaction is actually as an equity transaction. Here we will need to look at the main features that distinguish an equity from a loan. And what are those? The first thing that you can think of is probably loans have maturity and loans have maturity or term, and conversely, equity does not have fixed term within which the funds should be returned to the lender. Therefore, it will help in the defense of the structure if there are documents presented showing that there are no terms or maturity for the advances, and proof of the expectations or intentions of the parties would also help establish that there is no maturity or term into the advances. The second potential feature that we can explore in establishing that this is an equity is that loans go without an obligation to repay. Equity does not carry with it an obligation to repay. Thus, contractual arrangements showing that there is no obligation to repay can defend the structure. The third feature is that loans involve guaranteed return on investment. Equity, on the other hand, does not guarantee a return, but the return is dependent on the success of the investment. This proof of the intention of the parties to use the advance to grow the business without any expectation of a guaranteed return will also help in defending the structure. In these cases as well, we have presented agreements that show that the parties intend to convert these advances into equity at some future date. Finally, the functions and risk of the parties will also help delineate the transaction. In cases where the lender of the money does not have any participation in how the funds will be used and has left the use of the funds entirely in the discretion of the borrower, this could prove that the transaction is a loan. In contrast, where advance was provided and the shareholder has a say on how the funds will be used, can probably prove that the transaction is an equity. Again, this structure can be defended based on facts and evidence, and proof will vary on a case-to-case basis. Moving on, in the next slide, we will take a look at the principal model, which is prevalent in Southeast Asia. And for those that are not familiar with the model, we usually have an entrepreneur or a principal that sits in Singapore and has subsidiaries in across Southeast Asia that act as a limited risk manufacturer or distributor. The model limits the profitability of the subsidiaries by guaranteeing a cost plus or a resale minus return to the subsidiaries. And then the residual income therefore goes back or is captured by the Singapore entity, which performs the entrepreneurial functions. Now, in the principal model, the principal usually buys the goods from the limited risk manufacturer and then resells them to the limited risk distributors. And thus, in this model, the residual is captured by the principal through this buy and sell function of the principal. The issue arises when the principal does not buy or sell the goods from the limited risk entities, and the limited risk entities directly deal with the customers, as you can see in the diagram of the model on the left-hand side of the slide. Now, in this variation of the model, the limited risk entities capture the residual income that pertains to the principal, and the issue arises on the extraction of that residual. The residual income is usually extracted via service charges or royalty charges or a combination thereof, right? And recently, tax offices in Southeast Asia have argued that those service fees and royalty fees that represent the residual income should be included in the cost base of these limited risk entities for purposes of calculating the routine return for the limited risk entity. We all know that this means that the routine return will be significantly higher. For instance, if we include that service fee paid by the limited risk manufacturer to the principal in its cost base, the profitability will be significantly higher because we will be marking up as well that service fee. Now, what therefore are the types of defense or arguments we can present here to defend that those residual payments should not form part of the cost base of these limited risk entities? And the defense consists of a two-step defense. The first one is that we need to prove that the principal is entitled to the residual. And we should argue that the principal is the only entity within the structure that can perform those functions for which the residual income pertained. Similarly, we should also argue that the limited risk entities can only perform routine functions and bear routine risks. In doing so, the proof of the resources and capability of the employees of the principal as well as the limited risk entity must be presented. And this will entail showing the skills, the qualifications, and the infrastructure that both the principal and the limited risk entities have. And this will also involve showing the governance procedures of the group, showing who has the decision-making power with respect to those functions. Second, and most importantly, we should establish that the limited risk entity did not add value to the functions that are performed by the principal. This will show that the LRE did not add value to the cost that is being extracted, and therefore, but if we fail to establish this, it will give the tax authorities the argument that those residual payments should form the cost and the part of the cost base of the routine entities for the purpose of calculating their profitability. Again, if you look at this case, it again involves proving substance of the transaction and the value added contributed by the parties. I think I've run out of time, so this completes my presentation this afternoon, and I hope that I was able to share with you some valuable insights for this afternoon. Thank you.
Thank you, Carlo. We can see the tax authorities across Southeast Asia are certainly gearing up for more transfer pricing disputes in key areas like financing and marketing and servicing charges. We'll now hear from Karishma for India.
Thanks, Annalie. So in the Indian TP landscape, what we've seen, there are quite a few contradictory views on all the issues that we just discussed. And the first issue that I'd like to touch upon that Jax discussed in case of Glencore was the use of the cup method. As I mentioned, there are contradictory views on the India side. So when the taxpayer tries to use cup, the revenue service challenges, and on the other hand, when the taxpayer uses TNMM, the revenue service tries to use the cup. So this is quite a debated topic, but because of that, we've had the benefit on the jurisprudence front. At least we've had seen a number of principles that have shaped out of court orders, and that's what I'd like to discuss, and that's what I've put up in the slide here. So the first important issue, that comes out from the various jurisprudence is that, yes, cup being most closely connected to transfer price should be preferred, of course, over indirect methods like TNMM, cost plus, and RPM. But that's if reliable and adequate data is available. So that's the first part. It is not necessary that cup needs to be applied where you kind of get data only for same products. It can be even applied for similar products or services, provided scientific adjustments can be made. Now, we have seen the transfer pricing authorities using customs database in industries like life sciences and trying to make an adjustment, applying the principles laid out by Glaxo-Canadian court decisions. Even in such cases where scientific adjustments have not been possible, they have tried to advocate the use of cup method. This has been quite a pain point for most of the companies in the pharma sector, and we're looking forward to this issue spanning out at the High Court and what the High Court says. Then for transactions like royalty and financial services, again, in the good old days, taxpayers used to use TNMM and other more traditional methods to benchmark. Very clearly based on court jurisprudence, now this royalty transactions are required to be benchmarked separately. Unless you can really have a very strong case of aggregating them with the other transactions. Not to say that you cannot use TNMM, but the preference has tilted towards taxpayers to use cup and carry out a separate benchmarking analysis. So that's really the landscape we have on cup. Now, if we move on to the next slide. The second most, or rather I would say right now, this is the most awaited, issue that taxpayers are seeking settlement or, seeking some adjudication on, is on the issue of marketing intangibles. actually started. It's a very vexed issue, and it's around marketing intangibles, where applying the principles laid out by DHL of using bright line, the Indian authorities started actually to stake a claim that the extraordinary marketing and promotion expenses which were incurred by Indian subsidiaries actually resulted into brand enhancement, and it requires a separate compensation. So as I mentioned, this issue has been litigated for the last 10 years, and now it is up at the Apex Court for adjudication. As you would see, the issue basically, if you see in the next slide, the previous slide, if we can, that slide, correct. So if you see, this issue actually was first dealt with in the LG special bench case, where it was held by the tax court that in fact it blessed, rather I would say it blessed the views of the revenue service, where the tax court said that yes, if there is extraordinary AMP expense which is incurred, then this does deserve an adjustment. The bright line method can be used, and this is a separate international transaction. So with the LG special bench ruling at the tax court level, it traveled up to the High Court. In the High Court, basically, we had two landmark High Court rulings on this. One was in the case of Maruti Suzuki, which is a manufacturer, and the other is Sony, which is a distributor. So for manufacturing companies like Maruti, it was held that such AMP expenses incurred are not really separate international transactions or related party transactions, and therefore the adjustment cannot be sustained. For distributors like Sony, it was held by the court that AMP was part and parcel of the distribution activities, and therefore it can be benchmarked or aggregated together with the distribution benchmarking. What is important is to ensure that the comparables have the similar level of marketing intensity as the taxpayer, and if that can be done, then you can actually use an aggregated approach. It did not agree with the bright line method because it said that the bright line method is not as per the rules. So basically, as I mentioned, these two batches of appeals are now pending before the Supreme Court, and this is the next issue, which we believe in the next couple of months that the Supreme Court will look at, and therefore this is the much awaited adjudication on marketing intangible issues that we must track from a transfer pricing perspective. Moving on, another very litigated issue in the next slide, as you can see, is on payment for intragroup services or management fee payouts. So the debate raised here by the revenue service to challenge three aspects. One, rendition of services. Two, need of services. And three, the benefit for services. So if the taxpayer is not able to justify these aspects, then at the audit stage, these payments are disallowed. Again, these issues have traveled up to the High Court, and the principles that have been established at the High Court level are, and we have very, very reliable and relevant jurisprudence here on this issue. So the first issue that the High Court has dealt with is to say that aspects of benefit and need, these are more tilted towards commercial expediency, and these are the prerogative of the taxpayers. And therefore, revenue service really cannot sit to judge, whether these payments have benefited or need. If at all, what the revenue can look at is determining what is the arm's length price for such payments. And, TNMM can also be used to justify payments if the taxpayer can demonstrate that these intragroup service payments are interlinked to the other business transactions, and therefore, on an aggregated basis, TNMM makes sense to use. Also, revenue cannot just simply disallow the payment on an ad hoc basis. Such ad hoc disallowances are actually declared to be bad in law, and adjustments have been deleted in the courts. And one very last interesting issue in this was that, when we have retainer agreements, Generally, all these intragroup services are on call, not necessary. It will be a bucket list of like 15 activities that a regional service company would do. And it's not necessary that in a year, the Indian subsidiary would have received all the 15 services. So have also held that, in such retainer agreements, you can also be having a situation where Indian subsidiaries could have just received 2 or 3 or 1 out of these 15 services. And therefore, it is not required in terms of burden of proof from the taxpayer angle to establish that all the 15 services are rendered. So these are some interesting observations on the intra-group services. And if the last slide, if we move on, the most novel issues today in the recent 1 or 2 years that TP audits, TP authorities are focusing on is basically, some newer issues that they are trying to do, not the age-old issues. The first thing that they're looking at is inclusion of notional cost of free of cost goods and services received by Indian subsidiaries, especially for cost plus cases. Here, the details for such notional cost or valuation is obtained from GST filings, and therefore there is an interplay between TP and GST. Second, revenue authorities are moving away from using bank guarantee rates and moving to more sophisticated benchmarking models like the Halvite model. Third, non-resident companies, for example, receiving royalty incomes, interest income, which are taxable in India, they are also required to comply with the transfer pricing documentation requirements separately from the Indian subsidiary company. You can use the same benchmarking and flip it around, but you need to have separate documentation, failing which there's an exposure to penalty. And third, we have something called the other. Lastly, we have something called the other method in the Indian jurisprudence, where it's a very broad-based method where tax authorities are trying to use different approaches like revenue split, using quotations, and more trying to apply global formulatory approaches to kind of factor in market-based returns. So these are some of the newer trends that we're picking from the recent audits. So that's an update from India, and back to you, Annalie.
Thank you, Karishma. It seems that there are conflicting views in the case law in India, particularly around methodologies, which makes it even more important for taxpayers to get good advice up front and think really carefully about how they're preparing for a transfer pricing audit or dispute. As we can see, similar issues are emerging across the region, which leads us nicely into our panel session, where we wanted to explore some of these issues in a bit more detail with our speakers. So, Jacques, over to you first. You spoke a bit about the evolving role of CUPs in the Australian context, and we've seen the court in Glencore indicating that CUPs might have a bigger role to play as an indicator of arm's length behaviour when you're thinking about repricing or recharacterisation, as well, of course, as its more traditional role as a pricing benchmark. Glencore was able to produce a range of internal CUPs. Is that unusual, and what other evidentiary options are open to clients who might not have that kind of evidence available?
Thanks, Emily. Yes, I mean, CUPs, we've always agreed that they're the golden standard, but because the high comparability threshold under the OECD guidelines, we haven't seen CUPs being used as frequently. And often, especially in commodities, they are highly confidential and not in the public domain. Glencore, as one of the world's largest traders, was fortunate to have a range of CUPs that it could use to defend the position. When the BEPS project happened, the OECD acknowledged that this is a challenge. And if you look at the Action 10 paper on commodities, one of the things the OECD acknowledged, which is now in the 2017 OECD guidelines, is that references to index pricing, such as Platts and Standard & Poor's, London Metals Exchange, can be regarded as CUPs. So we are seeing an increasing use of those methods around commodities, but the case leads us to the situation where taxpayers, in my view, should really try and attempt to build a library of CUP transactions, because it is, even though we don't have the strict hierarchy we had previously under the 95 guidelines, the CUPs are still the most preferred method. And if we look at the recent case law around the world in commodities, all of those cases, either in favor or against the taxpayer, were all decided on the use of cups. So we expect that this will continue, and hopefully we'll see more publicly reliable data around cups. Thanks.
Thanks, Jacques. Karishma, just building on that same theme, we saw comments from the appeal court in Glencore that the burden on taxpayers might previously have been too onerous, in the sense that it's really difficult to find a perfect cup or indeed a single exact answer on an arm's length price. How is that playing out in India?
Right. So from an Indian angle, the party that is trying to use the cup, whether it's the revenue service or whether it is the taxpayer, that party would have the burden to demonstrate actually the reliability and appropriateness of the same. So therefore, I would advise from an Indian angle that the taxpayers, as Jax mentioned, should evaluate the existence of cup, evaluate it and look at if objective and scientific adjustment can be made, and also document these findings in the TP documentation. So even at the TP audit stage, if the revenue is actually trying to use a cup, then it is the burden and the onus is on him to actually share the cup data with the taxpayer, underlying data. If he does not share all the relevant factors to apply cup, it would be advisable for the taxpayer to, really ask for these details in writing, that, these are all the things that are required to apply the cup. And, so that even if the tax officer does not provide these details at the higher courts, at least you have a case where shifting the burden actually back to the revenue service. So that's what I would say from an India side. Sorry, Annalie, I think you're on mute.
Apologies. Thanks, Karishma. Carla, on a related topic, we're seeing a lot more from the courts and tax authorities about the role commercial rationale plays in a transfer pricing dispute. We know in most jurisdictions the provisions don't turn on subjective purpose, but how important is it to have a good story around commerciality around Southeast Asia right now?
Right. So, Annalie, if you look at the regulations in Southeast Asia, most of them do not have specific provisions requiring taxpayers that the transaction make commercial sense. But what we have in our regulations, because of the adoption of the arm's length principle, is that we need to prove that that third parties would enter into those transactions. And every time we do that, every time we prove that those transactions are something that the third party would enter, there is this implied proof that these transactions are commercially rational. Yeah, so which we think, which does not necessarily follow. But it is important because you need to show that the third party would enter into the transaction, otherwise you will not meet that arm's length standard that's imposed in all the regulations of the jurisdictions here in Southeast Asia. And
Karishma, how's that playing out in India?
Right. So, commercial arrangements with third party is absolutely something that can be used to demonstrate that, your transactions with related parties are at arm's length. In fact, in a very recent audit, where we had a long-term contract, the taxpayer was trying to use revenue split, and we actually got a similar third-party contract to demonstrate that, look here, in such long-term contracts, this is how parties behave. You can't, split the revenues in an ad hoc manner that you are proposing. This becomes a very crucial aspect. Commercial aspects can also be demonstrated by, giving calculations of return on investments. That's another method that we have seen. So if the return on investment is, let's say, for a parent company or a regional company investing in India, is lower than what it would, let's say, invest in other third-party situations, we also actually use such arguments. So these are again interesting concepts developing from the India side, Annalie, and I think time will come. It will be time for we'll have to see how the future spans out on this in jurisprudence. We've not seen any such things in the court, but yeah, that's what I would say from an India side.
Thanks, Karishma. One final issue to explore is around substance. So we're seeing continued tax authority scrutiny across APAC on the issue of substance of entities and operations in the global corporate structure, particularly where, for example, IP functions are said to have been migrated. Can we identify any trends emerging around the region in this respect? Maybe start with you, Jacques.
Yeah, thanks, Emily. I think substance is critical. You mentioned in the IP context, if we look at what the OECD is trying to do between the difference in DMP functions and legal ownership, substance and the ability to make the real decisions, the ability to have the knowledge to make decisions around intangibles and exercise control is critical. But if we bring the substance question back to the cases we discussed today, and we think about cups and the increase in usage by courts and taxpayers, we need to still consider substance, because saying that this is the way that third parties behave, if your tested parties do not have the same substance or structure, I do believe that tax authorities will still attack the substance. So having substance in the, say, a trading entity in Singapore, in Southeast Asia, or in Hong Kong, or somewhere else, when you're looking at comparability, even for cups, you still need to ensure that you've got the right classification. So as an example, if we have two transactions, one is a buy-sell distributor, doesn't hold the inventory, doesn't take major risk, and just buys and sells, and the other party is a fully fledged trader, has a full portfolio, optimizes that portfolio, has specialist skills. The transaction between the buy-sell trader and the transaction between the fully fledged trader may or may not be a comparable cup depending on the substance and the facts. So even when we are saying cups are becoming more prevalent, we still have to go through the levels of comparability. What the court in Glencore has said is, yes, it gives an indication of how third parties would operate, but I would still be cautious to say it is how third parties operate in the same or similar circumstances, which in my view means same or similar substance between the two parties in both the legal and economic terms. So yeah, substance really important across the region. Thanks, Annalie.
Thanks, Jacques. And it seems like Glencore keeps on giving, from an Australian context, with a lot of explanations around these areas. I'd like to ask Carlo now to provide some commentary around substance.
Right. So, Neil, if you look at the two cases that I discussed this afternoon, it actually revolved around substance, right? And substance was central to the, defending those structures in Southeast Asia. Now, if you look at the disputes that are happening in Indonesia and Malaysia, most of those disputes would require taxpayers to prove several points involving substance. One, tax authorities will require that in that structure, you have people that are located in those jurisdictions where you say the functions are being performed or the risks are being managed. And the second one is to prove that those people that are located in those jurisdictions actually have the skills or qualifications that would allow them to perform those functions or to manage those risks, right? Without which the tax authorities will disregard the structure and will interpret or will create its own structure in how they see the multinational companies operating within Southeast Asia. Therefore, the issue of substance is central to any defense in disputes in the most aggressive jurisdictions here in Southeast Asia.
Thank you, Carlo. And I think it'd be great to hear, Karishma, from your perspective, how the Indian Revenue Authority looks at substance in controversy in your region.
Right. So, I agree with what Carlos said, and that's a similar view from an India side. As you would have heard in the part one series that we had last time, GAR rules were introduced, which actually deal with substance more. But, from a transfer pricing angle also, this is a very critical aspect from an Indian side, because especially in cases where there are, regional distributor and service providers, and goods and services are flowing not directly but through such regional distributors and service providers. Often here the Indian authorities challenge duplication of functions of the Indian company versus regional hubs. So it will be critical to demonstrate the substance when the flow of transaction is coming through, say, let's say Singapore or Mauritius or Ireland or wherever. So it'll be that's one aspect. Also, in transfer pricing documentation, we generally characterize the operations based on the functional analysis. Let's say whether it's a licensed manufacturer or a limited risk distributor in India. So here it is not just the transfer pricing policy, I would say, that would determine the risk of the Indian party, because often you say that because India gets a guaranteed cost plus or a return on sales, India takes limited risk. And that's not been the view of the Indian authorities. What the Indian authorities or revenue service try to advocate is that who's the party who really has the capacity to bear and manage the risk, what Carlos said. So, and this is aligned to what BEPS Action 8 to 10 also advocates. I would say that the nature and the arguments of the capacity and the managing aspects of the risk need to be woven in a much better and a sharper manner in the transfer pricing documentation from an India side.
That's great. Thank you, Karishma. I think we'd like to move on to a slightly different issue now, and that relates to marketing intangibles. This seems to be another hot topic with regulators around the region. And I'd like to get your observations on marketing intangibles in your jurisdiction. Maybe I can start with you, Carlo, on thoughts on this issue.
Right. So on marketing intangibles, what we have seen in Southeast Asia, specifically, again, Malaysia and Indonesia, the challenge is usually on the, establishing who's the economic owner of the intangibles, right? So taxpayers have this burden of proving that this entity who's receiving the royalty performs the DEMPI function, right? And if you fail to establish that, that will lead to the denial of the deductibility of that royalty payments. And on the other side, when in doing so, if the tax authorities think that the local entity located in that specific jurisdiction is actually contributing to that DEMPI function, there are two things that they could argue. One is that the economic owner is now the local entity, and therefore that royalty payment should not flow outside of that particular jurisdiction. Or if it's not the economic owner, they will need to be compensated for that value add that they did for the in relation to the DEMPI function. So that's usually on a cost-plus basis. And for example, for marketing intangibles, the local entity is also performing incurring significant marketing expenses. And if the tax authorities think that those are value adding and should be compensated, they would ask the taxpayer in that particular jurisdiction to charge the cost plus a certain markup, or reduce the amount of royalty payment by the amount of the expenses that have incurred in the local market. So Neil, that's generally our experience here in Southeast Asia.
No, great, thank you, Carlo. And Karishma, I might ask you what the Indian experience looks like with this issue.
Right. So again, it coincides with what Carlos said. In Southeast Asia, either have a cost plus for the extraordinary marketing expenses, or disallow some royalty payments. These were the traditional methods which I also discussed when I spoke about my slides on marketing intangibles using the bright line concept. But in the recent audit, we've picked up that tax authorities are trying to use an aggregated approach. So if I'm a distributor and my marketing intensity is very high as compared to the comparables that I have chosen, then they would actually make a marketing intensity adjustment and try and say that, okay, I should not earn a 3% margin, but I should earn a 5% margin on my distribution activity, to compensate for the enhanced marketing intensity. And in fact, in certain cases, we are also seeing that if, these marketing intangibles are very significant, like you have for digital companies where consumer bases are large and, India becomes an important market and, that's what they consider as marketing intangible. They're also trying to use profit split approaches. So this, of course, goes to, the pillar 1, pillar 2 discussions and how things will shape up at a global level. And that's also something that India has been advocating on the OECD front very aggressively. So we'll have to see. But yes, for now, the treaties do not permit any additional attribution, right? If you look at the treaties, they do not permit additional attribution. So, APAs and bilateral especially can be a good tool to circumvent some such adjustments, I would say, and that's what we are actually trying from an India side.
No, thank you very much, Karishma. I think that's all the questions we have for our panel today. And I think that was an excellent last point that you raised, and probably worth a whole other webinar just to deal with it. But APAs are actually a great way to deal with controversy. And it's a tool that professionals employ across the Asia-Pacific region. And tax authorities are still open to APAs, although there are probably different experiences in different countries in terms of how this plays out, both in terms of time and effort involved. So for all our guests, thank you very much for attending our webinar today. That is all we have time for. Jacques, Karishma, Carlo, thank you very much for your excellent presentations today and your participation in the panel Q&A. Thank you, all of you who are able to join us today. We'd like to encourage you to fill out the short survey that'll pop up on your screen soon and tell us what you think about today's program. If you joined us late, please note this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please do share the webcast via the share this icon or have them visit the Debrief website. We'll respond to all the questions submitted during the webcast very soon. Also, if you think of any other questions or comments later on, please do feel free to reach out to myself, Annalie, or any of our speakers. We'd be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast, being part 3 of our series, in relation to how the tax authorities are administering the laws and conducting audits on Wednesday, the 7th of April. Lastly, from all of us at Deloitte, thank you for your participation today in Deloitte's Asia Pacific Tax Webcast. Thanks. Goodbye.